Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, good morning, everyone. So first of all, the exam timetable has been released. All right, so if you go to this timetable website and type in the Unicode, you will find the time and the location for the mid-semester test. Right, so that's 2 venues for 2002, Finland 2002, and I think there are 2 venues for Finland 7041. All right. And I made an announcement yesterday that the materials from week 1 to week 4 will be examined, except for the option trading strategy. But other knowledge points related to the options will be examined, all right? So that's the first thing I would like to mention. Okay, so the other thing is that sometimes, if you need some time to think about the stuff I just talked about, either in a lecture or workshop, please interrupt me, all right? Please just yell out to me, say, Mars, could you please stop and go through that concept again, because we didn't quite get it. So I will stop and I will go through that again. So, don't hesitate, just yell out to me, say, do that again. Okay. So on Monday, we talk about the option return stocks. So the underlying asset is a stock. I mean, obviously, we have other types of options. So we have options return foreign currencies. So some popular foreign currency, for example, US dollar exchange for Japanese yen, or US dollar versus euro, right? So for those popular currencies, there are options return them, and you can buy and sell them. So they are available for either the American option or European option. And also there are index options. So there are option return indices. So popular indices in Australia such as ASX 200 and ASX 500, right? And there are options that return futures contract. So we're going to provide an in-depth overview for those options, other types of options in future weeks after the semester break. So don't worry. So today I'll just briefly introduce them to you, but in the future week, we're going to have an in-depth examination of those different types of options. All right, so one interesting option I would like to mention is called futures options. Basically, it's an option written on the futures contract, right? So if you think about what a futures contract is, future contract is a derivative contract. An option is also a derivative contract. Basically, you have a situation that is a derivative written on a derivative that written on the underlying asset. All right, so it's a very mouthful, but it is what it is. So you might have an option written on a futures contract that written on gold. Basically, it's a derivative contract written on a derivative written on gold. So what happens when you exercise the option, there will be 2 things happening. Okay, so the first thing, you're going to end up with a position in the futures contract. Okay, so exercising, for example, exercising a call option on the futures contract, that means you commit yourself to enter into a long position in that futures contract. And the second thing is that you're going to get a cash amount that equal to the difference between the future price and exercise price of your option. So that is the futures options. Don't worry, we're going to go through, we will have an entire lecture on futures options in the future weeks. So today, just touch on it. Okay, so how do we deal with the underlying stock that pays the stock dividends, and how do we deal with the underlying stock that has stock split. So as I mentioned before, the dividends would have an impact on the stock price. So similarly, stock dividends would have an impact on the strike price. All right? So a lot of time, company pays the cash dividends. So just cash, for instance, BHP would announce that at the end of the financial year, that BHP would pay out 50 cents per share. So that is the cash dividends. But sometimes when company is growing, when company is lack of cash, and company would pay out stock dividends. All right, so instead of receiving a cash payment, you will have additional percentage of share in the company. So that additional share is stock dividends. So for example, for every 100 share you own, your dividend might be additional 5 new shares. Okay? So let's think about how to handle this sort of situation. Let's think about how to handle the situation where a company have stock split or company pay the stock dividends. So first, let me motivate why company would do stock splits. So just imagine we have 2 identical companies, company A and company B. All right? So company A and company B are identical in terms of the cash flow. So they have same amount of cash flow, and they would have same amount of risk. In other words, just imagine company A is just good as company B. However, the only difference is that the company sell 1 share for $1. All right, share is only worth $1 per share, whereas company B sell 1 share for $10,000. Right, so the share price is very high. But the underlying of these 2 companies are identical. And imagine you have $10,000. Which stock would you like to buy? $1. I mean, for the practical reason, yes, you would want to buy the $1 share because the lower share price means that more people can afford to trade on those stocks, and that implies higher liquidity in the market, higher trading volume, right? But if we ignore the liquidity, let's just assume that the capital market is frictionless, then the choice of buying company A and company B should be indifferent, right? So the decision of buying company A or company B should be neutral. However, for the reason I just mentioned, because the liquidity reason and because investors' psychological bias, because they think that for $10,000 they can get hold on 10,000 shares, it feels better, the investor tend to buy the stock with lower share price if 2 companies are identical. All right, so for that reason, companies have an incentive to split their stock if their share price is getting too high. Okay, just imagine if you own 100 shares and share price is worth $100, and the company would give you another 100 shares, but the share price would drop to $50. Okay, so company give you, basically company doubling the number of shares you own, but the share price have to half. The reason is because the market capitalization of the company remain constant. It's unchanged, right? They're simply doubling the amount of shares that you own, then the share price have to account for that. So the share price would divide by 2, so that's the $50. But your total net worth would remain the same, okay? And similarly, if the company pay, let's say, 5% stock dividends, that means you would have additional 5% of the shares. So that's 5% impact on number of shares, and that would also have an impact on the strike price. So let's have a look at this numerical example here. So the question says, consider a call option to buy 100 shares for $20 per share. And the question has 2 sub-questions. The first one says, for a 2-for-1 stock split, and how do you account for a 5% stock dividend? All right. Okay, so how do we adjust for the strike price? Because so the question says, is 2-for-1 stock split? So because it is 2-for-1, so for every 1 share you have, now you're going to have 2 shares. So that's how stock split works. So the company is doubling the number of shares you own, right? And this equation would do precisely that. This equation would adjust the strike price based on this stock split. So if you look at this numerator here, so 1 times the current strike price 20. All right? And what is the denominator is that the denominator basically asks the question, how many shares I will have now? Because it's 2-for-1 stock split, so for every 1 share I own, now I have 2. So this 2 indicate that for every 1 share that I used to own, now I have 2 shares. Well, if that's the case, then the strike price will halve. So now the strike price is $10. So this equation would adjust for the stock split. Now, remember the question says 1 call option would cover 100 shares. Now, because of the stock split, how many shares this option covers? So it used to be 1 option cover 100 shares. Now, because company is doubling the amount of share you own, so now 1 option would cover 200 shares, right? So 200 shares is how much the option is covering. All right, so similarly for the stock dividends, right? So the question says the company is going to pay a 5% stock dividend. So 5% stock dividend means you are getting 5% more shares, all right? So for every 1 share you used to own, now you own 1.05 shares, right? So for every 100 shares you own, now you own 105 shares. So that's basically what the denominator is telling you. So the strike price has to account for that, and the stock price has to reduce. So now the new stock strike price is 19.047. All right, so this equation basically says for 100 shares you used to own, now you own 105. That is the old strike price, that's the new strike price. Okay? And intuitively, before the stock dividends, each call option would cover 100 shares. Now, because you're getting 5% additional shares, so that's 1.05 multiplied by 100. Now option is covering 105 shares. All right? So these are 2 equations that would adjust for the stock splits and adjust for the stock dividends. So any question on that? All right, so extended options. So there is one type of option called executive options. So as the name suggests, it is kind of the option paid to company executives. So CEO, CFO, that sort of person, right? So traditionally, you have the cash salary, right? So you would pay cash salary to executives, and if they don't perform very well, as the shareholder, you have the voting right. You can vote and to fire them, right, if they don't perform very well. Alternatively, what you can do, instead of paying a cash salary, you can try to align their interest with your interest by using stock options. So as the shareholder for the company, what do you wish to happen? Of course, you wish the share price to go up, right? Now, you want the company to maximize its profit, to maximize its earnings, so that the share price can go up. So in order to incentivize your executives, you can give them options. Sorry, you can give them shares. Let's start with the shares. You can give them shares. Now they become the share owner of the company, right? The executive now become the shareholder of the company, and they also have an incentive to maximize the share price. Because executives usually have a tenure, right? That means they have a limit in terms of how long they can stay in a company. In 80s, executives did things in short term to maximize the share price. And then at the end of the tenure, they can walk away with a high share price, so they liquidate their shares. But because they did short-term investments, very risky investments, although that would increase the stock return, but at the same time, that also increased the probability of default, right? So that's the danger of just giving them shares. Now, in 90s, people figured this out, so company would issue stock options to those executives. And they would issue the option to the executive with very low maturity, right? So imagine the current share price is $10, and shareholder would give executives and a stock option with strike price of $15, and the maturity is 10 years. So hopefully, those executives cannot exercise those options 10 years from now, and this prevent them from doing very short-term things to stuff up the company. And hopefully in 10 years' time, the share price is higher than $15, and the executive can exercise their options to buy shares at a much lower price, so they can still make a profit. So give them executive stock option is kind of strategy to maximize, to align their interest at the same time preventing them from doing very short-term things. All right, convertible bonds. So you might have heard about convertible bond before. Basically, it's a hybrid security, yes? Yep. Yes. Okay, so let me elaborate on that. So basically, going back to the corporate finance unit you guys have learned, there's a famous theory called Modigliani and Miller, right? So what Modigliani and Miller says that the dividend is redundant. Why dividend is redundant? Because the dividend is redundant in the sense you can make the dividend by yourself. If the company, just imagine the company is a growth type company like Facebook, right? They need a lot of cash to do R&D, and they're very reluctant to pay out a cash dividend. Then you should not discriminate against those sort of stock, because you can always sell additional stocks to kind of synthetically make a dividend to yourself, right? So that's the theory behind that. So if that's the case, then people shouldn't value the company that's paying a dividend at a premium. So if that's the case, we shouldn't be worried about paying the dividends would have a conflict of interest, between shareholder and executives. But there are different type of conflict of interest, because later on we will mention that because the volatility will increase the option premium, right? So the volatility means the higher likelihood the share price would become in the money. So again, the stock option would still incentivize the executive to invest in very risky investments. At the same time, because they have a long position in the options, right? Although they cannot exercise the option for a very long time, but what they would do is they would write options, they would sell options, they would short options. So in that sense, they can still kind of, get profit from the short-term stuff. So yes, there's a conflict of interest, but I think the dividend, the factor is minor. I think the more important is, the volatility would increase the option premium, and they would short options. Yeah. Yeah, you can think that way. Yeah. Yeah. Any other question with executive options? Executive option is not perfect. Yeah. And sometimes another way to align your executive is give them insider debt, right? So make them become the debt holder. So give them very large pension, right? So pension is kind of the debt within the company. It's called insider debt. Now, in order to get their pension when they retire, they have to make sure they don't do very risky investments, right? To keep company safe. That makes sense? Yeah. All right, so any other question about executive options? Nope. All right, let's talk about convertible bonds. So as the name suggests, convertible bonds is a hybrid security. First of all, it's a bond, right? Just like any other bonds that, as the bondholder, you buy the bonds from the company that issues them, and because you're buying the bond, you become the bondholder, you get paid the coupon, and you will get paid the principal. That is when you don't convert your bond into equities, all right? But because the convertible bond, there is an option embedded in them, there's an option that's inherent in the convertible bonds, the bondholder have a choice, have a discretion to convert their bond into equity stake. That's when the debt holder thinks the company is performing very well. The share price will be very high in the future. Then they would have incentive to exercise their convertible bond and make them, converting them become equity stock holdings. All right, so the benefit of convertible bond is that you can protect those bondholders from downside risk. If they think the company is kind of risky, they can still remain as the debt holder and receiving the coupon, receiving the principal, and at the same time still allow them to enjoy upside gain. If the company performs really well, they can still have an opportunity to participate in company's equity and enjoy the share price, high share price in the future. Does it make sense? All right, so that's the extended options and other types of options. So as Monday, as I suggest that in terms of the bonds on the options, if the option price violates the upper bound or the lower bound, then that presents an arbitrage opportunity, right? So that's what I mentioned. So in today's workshop, I like to show you guys, in a case that the option price is trading lower than the lower bound, how can you set up an arbitrage strategy to arbitrage away this profit, to arbitrage away this price difference? Okay, just to quickly recap, how do we derive the lower bound for the option? So for the European call option, the way we derive the lower bound is by setting up two portfolios, right? We have two portfolios. In the first portfolio, portfolio A, we long 1 unit of European call option with strike price of X, mature in time T. And the second piece to that portfolio A is we long a zero coupon bond with a face value of X, mature in time T. And in the second portfolio, portfolio B, what we did is we long 1 unit of share, right? So by setting up those portfolios, we are able to show that, in 1 year's time, at the time T, there can only be two scenarios. There's a scenario when the share price is lower than the strike price, when the share price finish lowish, or when the share price finish highish, higher than the strike. Now we're able to show that in a low state, when the share price is lower than the strike, the cash flow from the first strategy is X, and the cash flow from the second portfolio is ST. And we understand that ST is lower than the X, so the first portfolio dominates the second portfolio when the share price finishes lower than the strike. So that's what we demonstrate in Monday's lecture. Now, if the share price finishes highish, higher than the strike, then both portfolio A and portfolio B will get a cash flow of ST. So they are identical when the share price finishes highish, right? So that's what we're able to establish. Now, because portfolio A is more superior when the share price finishes lowish, we argue that the setup cost of portfolio A should be at least as much as portfolio B and sometimes bigger, right? So that's the greater and equal sign going on there. Everybody understood that, right? Everybody understood how we derive this lower bound, yes? Can we move on with the arbitrage activity? Okay, so if we rearrange this equation, we get the lower bound for European call option should be greater and equal to the current share price minus the present value of the strike price. So this is what we deduced. Now, I would like to introduce a scenario where this lower bound is violated. So let's have a look at this question here. It says, a European call option written on a non-dividend paying stock with a strike price of 18 and expiration date in 1 year, and this call option is selling for $3. So that's the call option premium. And it also tells you the current stock price is 20 and the risk-free rate is 10% per annum, continuously compounded. I should have added continuously compounded. All right, so the question says, please calculate the theoretical minimum price for this European call option. We know what the theoretical minimum is because we derived the lower bound, right? And we also happen to know the share price is 20 and strike price is 18, right? So what we could have done is 20 minus the present value of 18, then we can deduce the theoretical minimum for this European call option. Yes? So we have those informations, and we plug into the lower bound equation, and 20 minus 18 times the e to the power of minus 10% multiplied by 1 year. And we work out this European coal option, the minimum price for this European option should be $3.71. Right? So the minimum price for this European coal should be $3.71. And how much is this coal option currently selling for? How much is it selling for? $3, right? So lower than the lower bound. So lower than the lower bound, therefore, we can do some actions today to arbitrage away this price difference. Now the question is, how do you set up the arbitrage portfolio? I will tell you one tip. The arbitrage portfolio will be set up based on this equation here, based on the two portfolios that we constructed. So what is in the first portfolio? We have a call option, we have a zero coupon bond. What's in the second portfolio? We have the underlying share, right? So that's the two portfolio here. Now, because the call option is lower than the lower bound, which means this European call option is underpriced. Yes? So you want to take a long position in the underpriced call option, right? So you want to long this call option. But loaning the call option is not the full strategy. Why? If you think about, if you take a long position in the call option, if you exercise the call option, what would happen to you? If you exercise this call option, what would happen to you? You need to pay the strike price X to get underlying share, right? When you exercise the call option, you need to pay the strike price X. So how do we get ourselves prepared for the scenario of exercising the call option? Perhaps you can start to save some money today, right? You can start to save some money that would make a payout of a value of X in time T, so that you can use that money that you just saved up to exercise the call and pay the strike. So that's why not only we need to take a long position in the European coal, but also we need to long the zero coupon bond. Long the zero coupon bond because in time T, this zero coupon bond would pay us value of X, which precisely equal to the strike price, right? So we can use the face value from the zero coupon bond to pay the strike. And what else we need to do? Because we're arbitragers, right? So arbitrager, we don't need to use our own capital. How do we finance our purchase for this left-hand side portfolio? Perhaps we can short sell the underlying share, right? We can short the share, and we use the cash proceeds today to finance the purchase for this left-hand side. Now, we don't have to worry about retaining the stock because we understand if we exercise the call option, that would lead to the ownership of the stock. Then we can use that stock to return to the stock lender. So we can close out this short position. Does that make sense? So that's going to be our strategy. Just bear in mind, your arbitrage strategy should be set up based on this equation here. So now let's do that. So let me just hide this part. Today, we're going to do something today. We're going to loan this underpriced call option that cost us $3. And we're going to take a long position in the zero coupon bond, and we pay the present value of the face value today. We pay $17. And in 1 year's time, we will be paid the face value. All right? And how do we finance this two purchase? Well, we can short sell the share. Shorting the share means we're getting $20 today. Right? We can use the $20 to finance this two purchase. So once we set up this portfolio, let's move forward. All right? So in 1 year's time, what would happen? There could be only two scenarios. Share price finish really low, lower than the strike, or share price finish really high, higher than the strike. So let's have a look at this blue column. Sorry, let's look at this column here. When a share price finish low, lower than the strike, $18, what would happen is that you have an out money call option, right? Because when the share price is lower than the strike, you're better off by buying shares from the market, right? So you don't exercise your call because exercising an out money call will lead to a loss. So you walk away from this out-of-money call option and let it lapse with a value of 0. What else do we need to do? Remember, we take a long position in the zero coupon bond a year ago. Now is the time the zero coupon bond pay us the face value. So how much is the face value? That's 17 times the e to the power of 10% and bring forward 1 year. So in 1 year's time, this zero coupon bond will pay us $18.79. So that's the face value of the zero coupon bond. That's us getting the money. But not to forget, we need to close off our short position for the underlying shares. Because we short the share 1 year ago, right? Now it's the time to return the stock to the stock owner. So what we need to do is we need to buy the share at whatever the market price is at the time t. So we pay the ST price to buy the share. Then we use the very same share to return to the stock owner to close off our short position. So how much profit we're able to make? The profit will simply be the face value of the coupon minus ST. So you just sum up this column here. You'll realize you're making a profit of $18.79 minus ST. Because we understand that ST is lower than $18, so you are making a profit that must be greater than 79 cents, right? Does it make sense? Because the share price is lower than $18, which means you are making a profit that's greater than 79 cents, right? So that's when the share price finishes low-ish, lower than the strike. Now the alternative situation is where the share price finishes higher than the strike. Now if it's higher than the strike, then our call option will be in the money, right? So then we should access this in the money call option. So access in the money call means we need to pay the strike price $18 to buy the underlying share. We have the money to pay the strike price. Why? Because we took a long position in a zero coupon bond 1 year ago, and now this zero coupon bond pay us the face value, $18.79. And we can use that face value to pay the strike price, $18, and we get the underlying share, then we return the share to the stock owner, and we close off our short position in the shares. Does that make sense? Then how much money did we make? We simply sum up this column here. We're making $18.79 minus 18. We're making 79 cents. So what does this strategy suggest us? If the call option violates our lower bound, if we set up a portfolio like this today, we can make a profit at least 79 cents and sometimes bigger. Right? So when the share price finishes really low, we're able to make an arbitrage profit that's larger than 79 cents. That's what it suggests. Does it make sense? Yes? Can you say that again? Why the zero coupon bond is? Yes, so as I mentioned, the zero coupon bond must pay, so the zero coupon bond must be, right. So basically, the way you think about where we get this $17 is that we short the share, right? So the shares currently was 20. So $20, we have $20 cash proceeds. We use the $3 out of 20 to buy the call option. And the remaining goes to the zero coupon bond. That's how you think about it. Sorry, I should clarify this. So when you're shorting the share, you'll be paid, so you will getting $20 cash in your pocket. Now you're going to spend $3 out of that 20 in the call option, and the remaining cash goes into the zero coupon bond. So the reason why we do this is because we want to have a zero setup cost today, right? So zero setup cost is the essence of the arbitrage strategy. Very good question, thank you. Any other questions? Okay, so let's move on to the lower bound. What about the European put option valid is lower bound? Remember the way we set up, the way we derive the European put option lower bound is by setting up two portfolios, portfolio C and portfolio D, right? We took long position in the European put, and we also long 1 unit of shares in portfolio C. And what's in the portfolio D is we long a zero coupon bond. And we managed to show that when the share price finishes lowish, when the share price is lower than the strike price, the cash flow of portfolio C and D are identical, right? So they provide the same amount of cash flow. When the share price finishes higher than the strike price, then the portfolio C is the superior portfolio because the cash flow is higher. Because of that, what we're able to deduce is the setup cost of portfolio C should be at least as much as portfolio D. Why? Because they're providing identical cash flow when the share price finishes lower, and the setup cost of portfolio C sometimes must be greater than portfolio D. The reason is because portfolio C is a superior portfolio when the share price finishes higher, right? So that's the basis for us to deduce this lower bound. So the lower bound for European put option should be greater or equal to the present value of the strike minus the share price. All right? Now let's have a look at this question here. So the question says, the European put option on a non-dividend paying stock with a strike price of 40 and expiration date in 6 months and selling for $1. And the stock price is 37, risk-free rate is 5% continuously compounded. It says, please calculate the theoretical minimum price for this European put. And if the option price is below its theoretical minimum, please set up an arbitrage strategy to exploit the price difference. Now we know how to work out the theoretical minimum because we have the lower bound equation, right? So the lower bound is basically the present value of the strike price minus the current share price. So that is the present value of the strike. We minus the current share price 37, we got the theoretical minimum for the European put should be $2.01, right? 2.01. But how much is this put is selling for? It's only selling for $1, right? Way too low. Lower than the theoretical minimum. Therefore, similarly, we can do something today to arbitrage away the price difference. How do we set up this arbitrage portfolio? Again, it should be based on this equation here. It should be based on these two portfolios. Now we understood the put option is underpriced, right? So we want to long the underpriced put option. Not only we need to long the underpriced put, but also we need to get prepared for the scenario of exercising the put option. What do I mean by that? In the case if the put option becomes in the money, in the case we exercise this put, what do we need to do? We need to sell the underlying stock at the strike price X, right? In other words, first of all, at least we need to have the ownership of underlying shares. Otherwise, when you exercise the put, you have nothing to sell, right? So whenever we loan this underpriced put, we also need to loan the underlying shares to get ourselves prepared for the scenario of exercising the put and selling the underlying share price for strike price X. All right? So how are we going to finance this purchase? How are we going to finance this purchase for the left-hand side? Well, we can short the zero coupon bond, right? Shorting the zero coupon bond also means borrowing at the zero coupon bond rate. All right, so let's do that. Again, today we're going to set up the portfolio. We short zero coupon bonds and we get $38. All right? And then we spend $1 on the put option and the remaining in shares. Okay? In 1 year's time, there could be two situations where the share price finishes lower than the strike the share price finish higher than the strike. Now, if the share price is lower than the strike, 40, that means our put option is in the money, right? Because what you could have done is you can buy from the market the lower price and exercising the put, selling for 40, you're making a profit. So we're exercising the put option and yes, so we're exercising the put option, we sell the underlying share for $40. So that's $40 coming into our pocket. So that's the plus sign. And what else do we need to do? Because we short zero coupon bond 1 year ago, right? Now is the time to repay that money. We need to repay this 38 with a bit of interest, 5%. So now we need to repay 38.96, right? So how much profit you made? You simply sum up this column here. So it's 40 minus 38.96. So you made a profit of $1.04. That's when the share price finished lowish. What if the share price finished highish, higher than the $40? Your put option finished out of money, right? You simply walk away from this put option, let it lapse with a value of 0. And you can sell the share. Now is the time to repay the zero coupon bond. The money we're going to repay the zero coupon bond is from selling the share because we own the share, right? So we sell the share at whatever the market price is at the time T for ST price. Then we use that money to repay the zero coupon bond. So the profit will be ST minus 38.96. And this time we will be making a profit that's larger than $1.04. The reason is because the share price in this situation is larger than 40, right? So we are making a profit that's greater than $1.04. So what this strategy earns us is a profit of at least $1.04 and sometimes bigger. Any questions? Yes. Are overpriced? Yes, there will be situation that is overpriced. So for instance, if the call option is overpriced, you can short the call. And because you short the call, you need to cover up your short position by buying the underlying share. Right? So in other words, if the call option holder exercises against you and you have the stock to sell to them. Right? So they commit to buy the strike, yes. Yeah, using the upper bound formula. Yeah. Yeah. Because the overpriced, the question is quite simple, so I will not give you a question on that. So the arbitrage question will mainly based on when the lower bound is violated. Okay. All right, so with the remaining time, I'd like to finish off the option strategy that we were not able to finish on Monday. So on Monday, I introduced you to the long straddle. And I mentioned the long straddle, you will be using the long straddle when you expect the underlying share price will be very volatile in the near future, right? And I also mentioned the way we're going to set up the long straddle is to take a long position in the call option and a long position in the put option on the same underlying stock with the same strike price and the same expiry months. So that's essentially the long straddle. And I also give you one example. I said, let's straddle QBE, right? So on Monday I said, let's straddle QBE. So the QBE share is currently selling for $9.64. And what we're going to do is we're going to long April expiry call option with a strike price of $9.75. So that cost us 14 cents. And we're going to take a long position in the April expiry put with a strike price of $9.75, and that cost us 27 cents. Okay? So the way I said to draw this diagram, to draw the payoff diagram, is that you can use something like this, a payoff table. Basically, you list a range of possible share price in the expiry date when the option expires, and then you ask yourself whether or not you would like to exercise the option. All right, so for instance, remember the first leg in the straddle strategy is we long a call option. So when the share price is $8, you ask yourself, do I want to exercise my call option? Because the share price is lower than the strike price, $9.75, the answer is no, right? You wouldn't exercise out of money call option. And the same decision will be made here when the share price is $9. $9 is lower than the strike price, $9.75. You would not want to exercise this out of money call option. So when are you going to exercise your call? Well, when the share price gets above $9.75, for example, when the share price is $10, you want to exercise the call option. Because exercising the call option means that you can make 25 cents gain. That's $10 minus the strike price, $9.75. And the same thing goes beyond $10. So anything above $9.75, you would make a decision of exercising the call option and making the profit. So we see the profit, the payoff getting bigger and bigger as the share price getting higher and higher. So this blue line really represents the payoff table, right? So when the share price gets above $9.75, we're making more and more profit. All right, so the second leg of the strategy is we long and a put option. Again, we're going to ask ourselves, do you want to exercise the put option when the share price is only $8? The question is yes, right? Because we're making the payoff of $9.75 minus 8, we're making $1.75 payoff. And the same thing goes to $9 when the share price is lower than the strike price, $9.75. Yes, we want to exercise the put. Exercising the put means we're making a profit of 75 cents. So the decision go all the way here. When the share price get above $9.75, you don't want to exercise your put option because now your put option is out of money, right? Exercising an out of money put will lead to a loss, right? So the decision on this point onwards is no. And this diagram here, this red diagram, this payoff table really suggests that when the share price gets below $9.75, you want to exercise and making a positive payoff. When the share price gets above that, you don't want to do that. Okay? So the next thing I said is sum up the blue column and the red column, you will get a gross payoff here. And then it cost us 41 cents to set up this straddle, right? So the gross payoff subtract the setup cost will give us this purple column here. The purple column represents the net payoff, net of the setup cost. And what you can see is when the share price finish exactly at the strike price, $9.75, we will be making most of the loss. The most loss that can occur to you is the setup cost, 41 cents, right? This purple line here. And this diagram illustrates exactly that. The maximum amount of loss is the setup cost when the share price finish exactly at the strike price. And when the share price finish really, really high, something like $10, $11, you're making big profit here. When the share price finish really, really low, like $8 or $7, you're also making a big profit here. In other words, as long as the stock price is really volatile, finish either really positively or really negatively, you're making a profit. If the share price is really calm and smooth, you lose 41 cents. That's the maximum you can lose. If we understand the long straddle, then let's have a look at the long strangle. Long strangle is very similar to straddle. When do you strangle in a share? When you think the underlying share price is going to be very volatile, all right? So this payoff diagram also suggests a very similar pattern. When the share price ends up being really, really high or really, really low, we're making positive profit on two sides, right? So what's the difference here? The difference is when you strangle a stock, you think it's getting extremely volatile, more volatile than a situation that you would set up a straddle. Why? Because we long a call option with strike price of K2, we long a put option with strike price of K1, and K1 is lower than K2. Okay? So which means we require the share price to be more volatile, to higher than the K2, we start to make a positive profit, to be lower than K1, start to make a positive profit. Now, the benefit of strangle is that our loss is kind of lowered, right?